experiences with trading in the markets. I'm going to recap. My first presentation was orientation to trading. I covered things like, you probably remember, your broker makes you broker, and some of the things like charts and indicators and that kind of thing, just basic things. And then I went over my second presentation, the basic things you need to have to trade. Last presentation, I went over some chart basics, and the main thing about charts and listening to the market is the trend is your friend. The other thing is everything you get from the market is a gift. So you may look at something and you may have taken $1,000 in profit and said, oh, if I just stayed in longer, I could have had $2,000. No, anything you get from them, it's not what the market takes from you, it's what anything you get from the market is a gift. So let's start. Basic indicators on a chart. We kind of went over this the last time. This is kind of a review. We have bars and sticks. We have balanced lines. The balanced lines, remember, they tell you where the price would have been if there was no change in the market, no price change. And then I'm going to go over these chart time frames more in detail. We just touched upon it in the last presentation. So, two main types of bars. You got this regular bar, it's open, high, low. So this is on this side, it's where it opens, this is where it closes. Now this is the same bar, but it's a candlestick. And I like this style better because I can look at it, and it's maybe because I've used it more. But I can see, okay, it opened here and it closed here, and I can put my mouse cursor over it and it'll tell me where it opened and closed. But candlestick will do the same thing. Now, this is easier to see in a presentation, so in my charts you're going to see today, you're going to see mostly candlesticks, or you're going to see they're all candlesticks, because it's easier to see in a presentation. So you can see it's going down, so it must have opened here and it closed here. If it was green, it opened here and closed here. And that's why, when you look at a candlestick, you have to kind of think, do a little thinking. Here you don't have to do any thinking. You know it opened here and closed here. You know right away, and it's red. But sometimes they're black, and you don't know. But candlesticks are always colored. So you can always tell the trend. The trend with just one bar is, for these bars, is down because it's red. And remember I said you split the stick up in thirds, and wherever it closed, that's going to be the trend. So this is down. If it closed up here, in the top third, it'd be up. It's called a climber. And if it closed somewhere in the middle third, you don't know which way it's going to go. It could go up or down. The next bar, the next day, the next hour, that kind of thing. So that's how you determine the immediate trend. One bar. So what makes the price move? It's the same thing that happens the day after Thanksgiving, when everybody stands in line to get that $200 60-inch big screen TV, right? They all run there, and they buy it, and all the TVs are gone, right? Or they've got too many of something at the grocery store, so they're going to go on sale and get rid of their inventory. The price is going to go down. Well, what happened here was that it's the same thing. The price opened here, and everybody thought that it's time to sell. So they sold, and the price went down. Now, they call that a correction. They also call it a bear. When the price goes up, it's a bull. And they also call it an impulse when it goes up. So the market's made up of impulses and correction, and it's always where everybody thinks the price should be. So the price is going to be somewhere on that bar. Let's say it's the daily bar. It's going to be somewhere in that daily bar because all the traders have determined that's going to be the price. So it's always impulse and corrections. So this is a chart. You can see there's no balance line. So it's really hard to determine what's going on here. So balance lines are used for a reference, and it's an indicator. It's like you're driving down the road and the little light, most cars have a little light that says, you're running out of gas. It's an indicator. Got to fill up, right? So the balance line is an indicator. Without a balance line, you really couldn't tell which way that market's going. Is it going up or down? It kind of looks like it's going down, but it's got some ups and downs. And this is a daily, so each bar represents a day. So if you started out over here, you could say, okay, tomorrow it's going to go up. So it went up, but the next day it went down a little, then it went up a little, and so forth and so on. It's really hard to determine here what's going on. So what they did back in the 20s is they came up with something called the balance line. It's an average. What they do is they take the point of open and close, and they divide it, and they plot a point, and then they graph it. So we got a blue line running through here, and that blue line represents 4 bars. So it's an average of the current bar going backwards. You can't really tell what's going on there even with 1 bar, because you notice most of the bars are sitting right on the line. Sometimes it jumps above the line, but you really can't determine. Like if you were here, you'd think that it was going to continue to go up. The next day it went down, and it kept going down. And you'd think it would continue to go down, but it started going up, and you hit this trend going way up. And you can't really tell as it's moving, is it going to stay in that trend or not? The most popular time frames that they use for bars is 4, 9, and 18, because 4 represents a week, 9 represents 2 weeks, and the 18 represents a month. It's how many trading days there are. And there's another one called the alligator that uses 5, but they use 4 because it's where that line sits on these bars. And I'll show you more as we go forward here. Now this is a 9-bar average, and you can see, you can kind of tell here that with this bar, it is an upward movement here. You can stay in, maybe not here, but it indicates that from here to here, you don't have to ever get out. You don't have to get out till somewhere up here, but then it goes down and it peaks. The 18 is even better, because now you can see a clear trend, but you can't tell when it's changing. So if you put all 3 bars on there, what can you observe? You can observe every time the blue bar, which is the 4 day, this is a daily, so it'd be 4 days, and the 9, wherever they cross, the price changes, and it goes down. You notice that when it comes above the green line, you notice that it went up, and here it's telling you that there's going to be a price change, a possible price change. It does dip down, it goes up, and then it crosses here, and this is actually current, so this is what happened today. It looks like now we're on a downtrend. So you can see the 3 lines, it really makes a big difference having those 3 lines on there. Now there's another popular indicator, which this is called the alligator. And I can't remember the time frames. The first one is 5. And with this one, the blue line is the balance line. So you can see as the price moves up, you can see even through this thing here, you know not to get out till the lines cross up here. It's time to get out. Now, this is called the Williams alligator, and Bill says that when the price crosses that blue line, it's time to get out. But he says when the price crosses the red line, that's another place where you can get out. Now, you would have probably gotten out here, but if you were using the blue line, you would have gotten all the way up there and maybe perhaps got out up here. But with this indicator, it opens and closes. So when the bars are inside the mouth, he calls it the mouth of the alligator, you don't want to be in the market. You don't get in the market till it's outside the mouth. So you're outside all the way here. This is where you get out. You might get in here, and then you would get out probably on that bar there. So you can see that these moving averages really help you know where to get in and where to get out and how long to stay in too. It talks to you. As you're moving here, if you got in here, let's say, you would have ridden it for, this is January, so in January you would have stayed in, February you would have stayed in, you would have got out here right probably today or yesterday or this last week. And you can see how many points You would have got in, let's just say 1010, and it's about 700 points roughly. And for this particular chart, it's $10 a point, so that's $7,000 you would have had just for the 2 months or so that you would have been in. So let's move on to time frames. A weekly chart, which you're going to see in a minute, shows the overall trend. The daily chart is the one you want to trade because that is where you're going to make all your money. A 60-minute, a 120, or a 240, it shows the immediate trend. The smaller the time frame, the faster the chart moves. So you're going to make less. The bigger the time frame, you're going to make more. So if you're trading a weekly, you're going to make more. But the daily is better, and I'll show you in just a minute. So you have to be really careful about trading anything than a 60-minute, any time frame smaller than a 60-minute chart, because it's very hard to determine which way it's going, and you have to get in and get out. Sometimes you'll be going in and out 3 times a day. So this here is a weekly, and you can see plainly, it's the same chart now. You can see plainly where you got this long upward trend. And even here it's still saying, I'm above these 2 balance lines. The trend is up, so stay in. On this daily, it's telling you the trend is changing to get out. This is a 60-minute, so this only goes 1, 2, 3 days. It's 3 days. So the last 3 days, you can see you would have been in and out several times. You would have been in for this move here, got out here, and you may have gotten in here and got out here and got back in and got out here and got in. So just 1, 2, 3 days, you would have been in and out 3 or 4 times or more. Whereas on a daily, it's months. Now, the neat thing about charts and indicators is back in the 20s, everybody was coming up with all sorts of indicators. And there was this guy, his name was Ralph Nelson Elliott, and you all need to Google him because he has a principle that has worked, and it's based on impulse and corrective waves. So you have, and this is found in nature too, you have this wave 1, which is an impulse wave, wave 2 a correction, wave 3, which is the longest one. That's that big wave we saw on that other chart. That was a wave 3. And you notice that there's a wave 4 down, and then there's a bump up. And let me go back. So you can see there's the wave 5, right? So after this wave 3, you know it's still going to go up one more time. So if you knew Elliott, you'd say, I'm going to stay in. And according to this, I can stay in. And got out over here and made more money. So after wave 5, there's an ABC corrective wave. So this is what happens. People start buying, and at some point, people get out. So it drives the price down. And when it gets down to here, all these guys that stayed in, or even the guys that got out, say, hey, the price is down. It's a fire sale. I'm going to buy. And they buy. And they get to this point, and they say, okay, time to get out. So some people get out. Then it's a fire sale again. They drive it up one more time, and then after that, it goes down and down. And it's the same thing here. They take their profit. When it gets to here, they say, oh, the price is going to continue to go up. So they buy. They get to this point, and they say, nah, we're not going to make it. And they sell. And that's the big sell-off. ABC. And then it starts all over again, another series of 1, 2, 3, 4, 5. And it's really important to know Elliott when you're trading because it really helps to know when to get in and out. So, I'm just going to review some rules. The rule of 7 is the price never moves more than 7 times, 7 bars. It'll move up or down. The 8th bar, it's going to move in the opposite direction. The other thing is you can't say yesterday or last month or last year the price went like this. Apple went like this last year, so it's going to do it again. It doesn't do that. That's why you have to follow the balance lines and you have to follow Elliott. Listen to the market. Let it tell you when to get in, how long to stay in. and then never let your expectation of saying, oh, I'm going to make $10,000 keep you in. Because like that other chart I was showing you, you would have made 7,000, if you want to make 10, you would have still been in and been losing as the price moved down. And I believe it's going to do an ABC, and you would have lost 40% or 50% of your profit. So it's really important to listen to the market. And remember that the trend is your friend. And take what the market gives you because it's a gift. Mr. Toastmaster.
Thanks so much. Mario, that was a big, complicated subject. So, you know, and it's very difficult to make that accessible or understandable to a lot of people, but I think you did a good job. I think you started out with a great recap of the prior speeches, which brought continuity and brought everybody up to speed. Then you went into how to use charts to figure out when to get in and out of the market. You described the balance line with either 4 or 9 bar, which indicates when to get in and out of the market. Again, that's a pretty complicated, weighty subject, but you did a good job with everything on that. And then you talked about time frames. Anything less than 60 minutes, probably too small. And just to kind of recap, you went over the Elliott wave principles, which is I actually found that one the most understandable. Great explanation of how people react to prices, and which drives them up and down, which causes people to get in and out of the market. But I found that one probably the most easy to understand. Did you have a clear description of the problem was one of the goals in the speech, and I think you did a great job with that over the multiple speeches. You made it pretty clear what can be accomplished. Did you humanize the data through anecdote or historical information? I think I would like to have seen a few more anecdotes. Probably would have helped me kind of dumb it down for me, because that's a tough subject to understand. Conclusion. You concluded with a recap of the rule of 7, lightning never strikes twice, and the trend is your friend, which are some great kind of rules of thumb to help you remember some of these things that you went over. Overall, I thought you did a very good job.